I am Jeremiah Ajuda Dusu, the author of JAD's Business and Financial Accounting. I am welcome to class. Okay, so let's not waste time. Okay, of course, it's been a group balance sheet or consolidated balance sheet. Okay, and we are actually progressing. Let's take another aspect here. Okay, so it's group. So today we're looking at Scrip shares issued by a subsidiary. Okay, so when I say Scrip shares or Scrip issue, I mean bonus shares. Okay, or you can call it free shares, or you can say shares with zero investment. That's from the perspective of the person that is receiving the shares. Okay, so what we're saying here basically, of course, you know what bonus shares is. I think I take the class on bonus shares anyway. So what we're saying here is that the particular company is, giving out shares without receiving money. That's, typically when you issue shares, you expect to, get money for that. That's use the shares to raise funds, right? That's the way it works. But bonus shares here, we're saying that you're giving out shares without payment. That means those that you're giving the shares are not paying you, so they are getting the shares for free. So from their perspective, they are not investing any amount of money to get the shares. They're just taking the shares and they are not paying. So you that are issuing the shares, you're kind of bearing the cost of that free shares. Okay, so typically where there's a bonus issue or where there's a bonus share, it simply means that the share capital, of course, will increase by the number of shares that you have issued, but your reserve will reduce. Okay, so typically it is between your reserve and the share capital. So the share capital, or let's say the reserve, of course, will decrease. So that's a debit. Share capital will increase. That's what? A credit. So it simply means that, at every point in time where bonus issues are made, the share capital increases, then the reserve decreases. Okay, but in this scenario, we're looking at it from the perspective of what? Of group balance sheet, where the subsidiary is actually issuing what? A bonus what? Share. So, of course, we already understand, or we have established the fact that, where there is what? A bonus issue, or a bonus share, the reserve what? Reduce. So, if your reserve, let's say your reserve is 500, share capital, let's say, is 1,000, then you now give or you issued a bonus share of, let's say, 100 units. Of course, 1 naira per share, that's 100 naira. So that means your share capital will increase, which is 100, that will be 1,100. Your reserve will reduce by 100, which is what? 400. So your share capital has taken a credit entry. Your reserve has taken what? A debit what? Entry. That's what has happened here. Okay? Now, because we're talking about, bonus share at consolidation. So, since it's a bonus that will affect the reserve, so we have to now establish where the reserve that is being affected is. Is it at pre-acquisition or at what? post-acquisition. So it means that bonus shares will have effect on your pre-acquisition reserve or your post-acquisition reserve. So what this means is that at every point in time where bonus shares are issued, they are either issued from the pre-acquisition reserve or from post-acquisition reserve. Now, when they are issued from what? The pre-acquisition reserve, okay? Now we have to establish whether, as at the point of consolidation, where the shares are issued from pre-acquisition reserve, have there been an adjustment? So we have to establish two things here. Has it been adjusted for, or it has not been what? Adjusted for. So when I mean by adjusted for, I mean has it been accounted for? So as at the point that this consolidation is being made and there is a bonus share that has been issued, has it already been accounted for or has it been adjusted for? If it has already been adjusted for, then we just have to establish the fact that it has reflected in the expected ledgers or expected, entries. So once we establish that fact, we go ahead and consolidate. Okay? But if it has not been adjusted for, it means that we will now have to take the right step by taking these entries. So if it has not been adjusted for, we expect that we take the right entries by debiting the pre-acquisition reserve and crediting the share capital. So after doing this, we can now go ahead and consolidate. Okay? But then we also have to know if it is from the post-acquisition reserve, we have to also know, has it been adjusted for or it has not been adjusted for? I already explained what happens where the bonus is being issued from pre-acquisition reserve. Here, post-acquisition reserve, we have to know, has it been adjusted for or it has not been adjusted for? Now, if it has not been adjusted for, what is expected is that we take this step by debiting reserve and crediting share capital. But don't forget that at consolidation, there's something called post-acquisition reserve. And that post-acquisition reserve is only for the reserve after acquisition. But we do not have anything like post-acquisition share capital. So if there is a bonus issue from the post-acquisition reserve, then that has not been adjusted for. Now, if we have to adjust, that means we have to do what? We have to debit post-acquisition reserve and credit share capital. So that means we are moving a post-acquisition element of the reserve to the share capital. And when we are spreading the share capital, we don't spread it across cost of control, minority interest, and post-acquisition, or we call consolidated profit and loss. It's only between cost of control and minority interest. This is what I'm saying. Of course, you have cost of control, minority interest, and CP and L, right? So if you have your share capital, it's between this guy and this guy. Reserve is between this guy, and this guy. So this is how you spread it. So the reserve, you can have the pre-element, minority interest, and post-acquisition element. But share capital is just cost of control and minority interest. So if you're having bonus issue from post-acquisition reserve that has not been adjusted for, it simply means that if we have to take this step, it means we now have to move it from post-acquisition reserve to share capital. And when we now spread, it will not have any effect here. That is what it means. So it means you're going to be having a post-acquisition element in the goodwill computation, which is not typically what we do when consolidating. So because of that, where you have bonus issue from post-acquisition reserve that has not been adjusted for, you ignore. You what? Ignore and consolidate. Ignore it and consolidate since it has been adjusted for. But where it has been adjusted for, then you have to reverse it. So that means that they are already taking this step. So all you need to do is to reverse it. So how do you reverse it? You will now credit your what? Reserve. Of course, that's post-acquisition. And then what now? Debit your what? Your share capital. So that's a reversal. So once you reverse it, you can now go ahead and what? Consolidate. So what I've said here is simple. Where there is a bonus issue out of post-acquisition what? Reserve, if it has been adjusted for, you have to reverse it. If it has not been adjusted for, you ignore and consolidate. Okay? Because you do not want to bring a post-acquisition element into the computation of what? Goodwill. Okay? So this is, a summary on what? Bonus issue by what? A subsidiary. I've explained that when you issue a bonus, or when a subsidiary issues a bonus at consolidation, you have to establish if the bonus was issued out of pre-acquisition reserve or post-acquisition reserve. If it is from pre-acquisition reserve, you have to establish, has it been adjusted for? If it has been adjusted for, then establish the fact that it was actually it has been entered in the right what? Ledgers. Then once you establish that fact, you can go ahead and consolidate. But if it has not been adjusted for, take the right step by debiting what? Pre-acquisition reserve and creating your what? Share capital. After doing that, you can consolidate. But if it's from the post-acquisition reserve, you want to know also, has it been adjusted for? If it has been adjusted for, then it means you have to reverse the entry because you do not want to bring in post-acquisition what? Element. But if it has not been adjusted for, ignore and what? Consolidate. So there's no need for you to raise the journal. Just go ahead and what? Consolidate. So take your time, go through it. If you have questions, you can read on the numbers expected to reply with the right answers. So we're taking questions now. Let's take questions. We're taking 4 questions that will help us understand, the 2 areas here and the 2 areas here. That's 2, scenarios in pre-acquisition reserve and 2 scenarios in what? Post-acquisition reserve. So let's really take that question so you understand what we're talking about. So let's quickly take this question. We're taking 4 questions, okay? To help us understand the 4 scenarios. All right? So let's take the first one here. So here I have the following represents the balance sheet of Kings PLC and Queens PLC as at 31st 2018. So we have Kings Queens. Here we have the assets here, we have liabilities here. So additional information, say Kings PLC acquired 90% shares in Queens PLC on 2016 when its reserve was 400. Queens PLC issued 200,000 bonus shares from the pre-acquisition reserve. Okay, and this is yet to be adjusted for in the books. So you're required to prepare the consolidation schedule and consolidated statement of financial position. So here, the first question here is saying that Kings acquired Queens, but Queens also issued bonus shares from the pre-acquisition reserve, and these have not been accounted for. That's the first scenario, right? So let's see how that will go. So this is consolidation schedule. Okay. So we're going to have, because this is question 1, so we have a cost of control, which is 90%, minority interest, which is 10%, because this is kings and queens. Then we have C, P, and L, right? Okay, so what do we have here? What do we have here? So we have the share capital of Queens to be what? 2 million. Reserve 1 million, that's in the balance sheet. But then they said Queens PLC issued 200,000 bonus shares from the pre-acquisition reserve. Okay, and this is yet to reflect. So what do we have? We have 200,000 bonus worth shares. Share capital is 2,000. Pre-acquisition reserve is what? 400. So the bonus share has been issued from the pre-acquisition reserve. So that will mean that share capital will increase by what? 200. Reserve will decrease by what? 200. So that means share capital is 2,200. Pre-acquisition reserve is what? 200. Going by debiting pre-acquisition reserve and crediting share capital. This is what we're going to get. Okay? So that means share capital here is 2,200. So we have Queen. Share capital is 2,200. So what's 90% of 2,200? So 90% of 2,200 as 1,980. So we have 1,980. 10% of this, I think, should be 220. So when you add up, what do you have? 1,980 plus 220. That's 2,200, okay? So what's our reserve? Our reserve here, of course, you know, our reserve according to the balance sheet is 1,000. Cumulatively is 1,000. But don't forget that the reserve had moved from 400 to 1,000. Okay? So now, if the pre-acquisition reserve is reducing by 200, thereby increasing the share capital to what? 2,200. Cumulatively, it will now be what? 1,000 minus what? 200, which is what? 800. So the reserve here now will be what? 800. Of course, that will take the balance sheet of the subsidiary, you know, to the right position for this consolidation. Okay? So that means you're going to have 800 into 2, pre and what? Post. So this here will be 200, this here will be what? 600 times 0.9 times 0.9 times 0.1. So let's go. What do you have? What do you have here? So you have 0.9 times 200. That's 180. So 0.9 times 600. Okay. $540. So 0.1 times 800, I think that should be 80. So if you add up, it should give you 800. 180 plus 80 plus 540. 800. Okay, so let's see, we have our net asset acquired here. This is 06, I think this should be 2160. So cost of investment here, according to the question, is 3,500. So goodwill here will be 2160 minus 3,500. $1,340. This is the goodwill. Minority interest to be 220 plus 80, that's 300. Then King's Reserve. According to the question, King's Reserve is what? 300. So we have 3,000 rather. That'll be 3,540. So this is the schedule. Okay. So after the schedule, what do? We prepare the consolidated statement of financial position. So let's just do that here. Let's say Kings and its what? Subsidiary. Consolidated statement of financial position as at 31st December 2018. So let's go. We're going to have it like this. So what are the assets? So we have total tangible assets. That's 4,000 plus 3,000. That's 7,000. What's the goodwill? 1,340. So when you add up, you have 8,340. So let's go. What's the liabilities now? We have reserve. What's our reserve here? 3,540. What's the share capital? According to the question, share capital is 4,500. Then what's the minority interest? 300. So when total you already have 3,540 plus 4,500 plus 300, 8340. Okay, so this is for the first question. So what we've done here basically is to prepare, a consolidated balance sheet with bonus issue. Okay, and that bonus issue, the subsidiary issued the bonus but has not adjusted for it. So we had to do the adjustment. Okay, so this is what it looks like. So we're going to take the next question to help us take or understand the next scenario. Okay. So we have the next one here. The following represents the balance sheet of Kings PLC and Queens PLC. So we have it all like that, same information. But here they are telling us that Queens PLC issued 200,000 bonus shares from the pre-acquisition reserve. This has been adjusted for in the books. So in this scenario here now, there's a bonus issue. Okay, there's a bonus issue that has already been adjusted for. So it means that what you have in the balance sheet is okay, it's already adjusted for. But now we have to now be sure that every item, okay, is reflected correctly. So if you look at it very well, what they call it here now, your share capital, according to the question, is correct. There's no need for you to adjust because they say it has been adjusted for. So you don't need to adjust it from 200 to 2,200 because they said it has been adjusted for. So that means your share capital of 2,000 is correct already. Your reserve of what? 1,000 is correct already. So the only thing is that the pre-acquisition reserve, is it correct? Because if you acquired when the pre-acquisition reserve is 400, and then you now went ahead to what? Issue a bonus share out of the pre-acquisition reserve, then that means that there ought to be what? A reduction. Okay? So in that case now, pre-acquisition reserve here now, this 400 now reduced to 200. These ones here are already correct, but this 400 will come down to what? 200. So our pre will be 200. Our post will be what? 800. The reserve here remains 1,000 because they say it has already been what? Adjusted for. So let's quickly take that aspect. So let's call this question 2. Of course, we have consolidated or consolidation schedule. Okay, as usual, let's do that sharply here. Cost of control, minority interest, CP and L. Okay, because this is Kings and Queens, 90%, this is 10%. Okay, so we're going to have Queens here. Share capital is correct, so that means it's 2,000 according to the question. So 90% of this will be what? What's that? Let's check. 2,000 times 0.9, 1,800. 1,800. So that means this will be what? 200. So your reserve is 1,000. It's correct, but they say it has already been adjusted for. So that means that will be 1,000 pre and what? Post. This will be 200. This will now be what? 800 times 0.9 times 0.9 times 0.1. Okay, so 0.9 times 200 will still give you what? Sorry, yeah, of course, still 200. So 0.9 times 200 is what? Will still give you 180. Give you 180. Okay, so what is 0.1 times this? This will give you 100. 0.9 times 800. What do you have? 720. Okay, so this here will be 0.891. This is your net asset what acquired. So cost of investment remains 3,500. So what do you have? 1980 minus 3,500. 1,520. This is your goodwill. Okay, so minority interest here, what? 300. King's reserve is 3,000. So that will be what? 3,720. CP and what? L. So what will the balance sheet look like? So we still have Kings and its subsidiary, right? So we have consolidated statement of financial position as at 31st December 18. Assets. So total tangible assets is still 4,000 plus 3,000. That's 7,000. What's our goodwill in this scenario? Goodwill here is 1,520. So total here is what? 8,520. So what are our liabilities? Reserve is what? 3,720. Share capital is what? 4,500. Minority interest is what? 300. So what do you have? 3,720 plus 4,500 plus 300. 8,520. So this scenario here is to help us understand, bonus issue that has been made by the subsidiary and has been reflected in the books. Remember I said the first one where it has not been adjusted for, we adjust for it and then consolidate. But where it has been adjusted for, we just establish the fact that the right entries have been made and then we go ahead and consolidate. This is the question 2. So the next one now, of course, this is both from pre-acquisition reserve. So the next one here now, third question. Okay. third one here from post-acquisition reserve. So we have the following represents the balance sheet of kings and queens. So we have it all down there. So they are saying that Queens PLC issued 200,000 bonus shares from the post-acquisition reserve. This is yet to be adjusted for in the books. This is yet to be adjusted for in the books. Okay, so in this question now, there is bonus issue from where? The post-acquisition what? Reserve. There is a bonus issue from the post-acquisition reserve. Okay, but it has not yet been what? Reflected, or it has not been adjusted for. And I told you, say when you're talking about post-acquisition reserve and it has not been adjusted for, you ignore and then consolidate. So you do not adjust. Because if you adjust, you're going to be bringing post-acquisition elements to the consolidation. Of course, the conversion of what? Goodwill, which will affect the share capital. So in this case, you just ignore and then consolidate. So let's see how it will look like. So we have question 3 here. Consolidation schedule. Cost of control, minority interest, CP, and what? L. So we have Queens share capital here. So the reserve, the bonus is from the what? Post-acquisition reserve. And I said in that case we ignore and what? Consolidate. So what's our share capital here? It's 2,000. Okay, so what this is 90%, this is 10%. So this is 1,800. This will be 200. Your reserve is 1,000. But in that case, you're going to have 1,000 into pre. Your pre is 400. Your post will be what? 600. Okay, this is 0.9, 0.9, 0.1. So 400 times 0.9. 360. So we have 360 here. I think this will be 100. 600 times 0.9. 540. So this will be what? 0.6. This will be 1. This is 2,160. As net asset acquired. Cost of investment is 3,500. That means you're going to have, what do you have here? 1,340. Similar like that one here. So this is the goodwill. Okay. So you're going to have 300 here. That's minority interest. King's reserve is 3,000. So you're going to have 3,540. Okay. So what we've done here is that there is, bonus issue from the post-acquisition reserve. So what we're doing here, we're going to, we established that it has not been adjusted for, but because of the post-acquisition elements, we ignored and then consolidated that way. Okay, so you have it like that. So let's prepare the balance sheet. So what's the balance sheet like now? We have what the Kings and its subsidiary. Consolidated statement of what? Financial position as at 31st December 18. So total tangible assets is 4,000 plus what? 3,000. That's what? 7,000, right? What's the goodwill? 1,340. That's 8,340. Liabilities. What's the reserve? Reserve here is 3,540. Share capital is 4,500. Minority interest here is 300. So we're going to have 8,340. So this scenario here is for, post-acquisition reserve, bonus from post-acquisition reserve that has not been adjusted for. So what we did is just to ignore, to avoid bringing post-acquisition elements into the share capital and then consolidate. Now the next scenario now is where it has been adjusted for. Post-acquisition reserve, a bonus issue was made from post-acquisition that has been adjusted for. So we have to what? Reverse. I already explained that. So let's take that. Let's put that here. So let's take that one. So here is the same question. Before I present the balance sheet of Kings PLC and Kings PLC at 2018, so we have assets, we have liabilities, share capital. But they say Kings acquired 90% in Queens when reserve was 400,000. The Queens issued 200,000 bonus shares from the post-acquisition reserve. This has been adjusted for in the books. Remember I told you, I said where there is bonus issue from the post-acquisition reserve and it has been adjusted for, we have to what? Reverse it because of the post-acquisition that has already been what? Entered in the share capital. Okay? Because your share capital spread is just between cost of control and monetary interest. It doesn't go to CP&L. So in that scenario, you have to bring it back to what it is. So you avoid that post-acquisition element to be part of the computation of your goodwill. So here's what we're saying. So this is question 4. Consolidation schedule. Of course, we have cost of control, minority interest, we have CP and what L. Okay, so this is 90%, this is 10%, because this is Kings and Queens. So we have Queens, share capital. What's the share capital? Remember, the bonus issue has been adjusted for. Okay, the bonus issue has been adjusted. So what's the share capital here? Share capital here is 2,000, of which the bonus issue has been adjusted. So we have to now readjust. So the share capital is 2,000, reserve is 1,000. The bonus issue has already been entered in this share capital. Of course, it's from post-acquisition. So we don't want to bring a post-acquisition element into the share capital. So we have to reverse it. So that means this guy will go out here, 200 will go out here. This guy will have 200 here. So this will become 1,800. This will become what? 1,200. So your share capital here is 1,800. 90% of 1,800. $1,620. 10% be what? 180. Okay, so what's your reserve? The reserve will be what? 1,200. So that will be what? 1,200. Pre will be 400. This guy will be what? 800. Right? Excuse me. So 0.9 times 400. 360. We have 360. 10% will be 120. CP and L will be 90% of 800. $720. So what do you have there? This is 0, this is 8, this is 9, this is 1, 1980. So net asset acquired. So what do you have here? Cost of investment is 3,500. So if you take that out, what do you have? That will be 152, just like the other scenario there. So this is goodwill. Minority interests will be what? 0, 0. This is 300. So King's reserve cost is 3,000. So we have 3,720. CP and L. Yeah. So let's do the balance sheet there. I believe at this level you understand what I'm doing. Just so we have Kings and its what? Subsidiary. Consolidated statement of financial position as at 31st December 2018. So we have assets. Total tangible asset is 4,000 plus 3,000. According to the question, that's 7,000. Goodwill is 1,520. So we have 8,520. So what's the liabilities? Reserve is 3,720. Share capital 4,500. Minority interests is what? 300. So when you add up, what do you have? So we have 3,720 plus 4,500 plus 300, 8,520. Okay. So this is, questions covering the 4 scenarios. Okay? So take your time, go through it. If you have questions, you can reach me on the numbers displayed to provide the right answers. And don't forget, you can support us by printing the account numbers displayed, or sponsor code on my textbook, or free distribution to students. Thank you, and see you next class. Bye-bye.